What do you make of the futures pulling back? I mean, we saw that the CPI come in line. A lot of people believe that's going to lead us, the jobless claims are going to lead us to a cut. Why are we seeing this pullback today? Any idea?
Well, Frank, the number one thing that matters for next week is, of course, the resumption of the Fed's easing cycle. And I actually think it drives a pretty constructive market setup going into the next 6 months. Now, even though that easing is going to be driven by weakness in the labor market, the broader setup is pretty constructive. We have a strong earnings backdrop, strong forward earnings guidance, and capex intentions by those market leaders. The economy is not in recession. When you sprinkle easing on top of that, I think it's supportive enough for animal spirits over the coming few months to limit equity market downside as opposed to extending the economic cycle altogether.
Yeah, in all fairness, we're hitting all-time highs. So we're pulling back from all-time highs and just very fractionally right now. I want to talk to you about the president and also Lisa Cook, his efforts to get her removed before that Fed meeting next week. How do you think the market's going to interpret just this turmoil and the questions about Fed independence, or at least the fact that the president's trying to have a bigger influence over the Fed? I don't know if you read this, but Ken Griffin out with an op-ed just a few days ago, just talking about the impact of the president trying to, I guess, interfere with Fed independence and how it could raise not only inflation, but also bond yields.
Well, the independence of the Fed is a critical part of how U.S. capital markets and, candidly, global capital markets function. Where I think we're going to see a potential market reaction to any credible threats to Fed independence, and this could be at any point between now and any point in the future, would actually be in the long end of the curve. We have seen a really strong rally in rates across the curve that's been particularly notable on the long end. And in my view, we're right near the bottom of what I would consider to be a credible 10-year range for this cycle, which is between 4 and 4.8%. So from here, I actually think that we could see a little bit of pressure upward, not only because of potential concerns about Fed independence, but because of the huge amount of fiscal spending that we still have on our plates.
I want to go back to the broader markets again. S&P and NASDAQ, as well as the Dow, hit record highs yesterday. A lot of people have been concerned, as we've seen the markets rise this year, about concentration and over-concentration of just a few names. If you look at the Mag 7, they're about 33, 34% of the S&P. But you say that's not actually a problem. Just explain, because everybody else is worried about high valuations and over-concentration, but you say it's just the opposite. It may be an advantage.
Yeah, I'd be a lot more concerned about concentration of price action and valuations if there weren't also the earnings there to back things up. We also might consider concentration to be a bit of a saving grace for the market because the leaders of the market right now are being driven by long-term belief in the artificial intelligence theme, not by hopes that sustained interest rate easing is going to extend this cycle and push major earnings growth into small caps and into other portions of the market. The fact that AI has been a less interest rate sensitive theme could protect the market from potential disruptions to easing expectations, which could stem from upside risk to inflation.
I want to go back to that weakness in the job market. Jobless claims coming in a bit higher than expected. We saw the downward revision. We got the jobs report last week, much softer than expected. Does that change your view on any of the cyclical sectors that generally would benefit from an easing cycle from the Fed? Does it change your view on consumer discretionary? Does it change your view on housing, maybe even regional banks? I mean, just the fact that we may be seeing a significant weakness in the job market that would obviously impact the consumer that so far has been spending, but that could change.
Yeah, obviously we've seen a huge deterioration in the labor market already in that hiring has ground to almost a complete halt. But I think that we need to see more weakness in labor, specifically in layoffs ticking up, before I could feel confident that we're going to see a sustained easing cycle. Right now, I think there's a lot of focus on that one side of the Fed's mandate, but we need to remember that upside risks to inflation have not abated whatsoever. Now, given that we might expect a more moderate easing cycle right now that's sporadic between here and perhaps the middle of next year, I'm not sure it's going to be enough to move the needle on, for example, housing affordability with those looking for a more affordable mortgage rate. I'm not sure it's going to be enough for a holistic new spark in credit creation, but I think that some modest easing is going to, of course, be enough to manage the extent and the pace of any economic slowdown we're looking at from here.
Is there one sector you're seeing as being the biggest beneficiary of this expected rate cut? Again, expected to be a 25 basis point cut, but traders seem to just continue to keep a 50 basis point cut on the table.
Yeah, well, I think that financials are a clear potential beneficiary here of a bull steepener as the Fed cuts rates. Again, part of that story is going to be the question about what happens on the long end. I would not be surprised if we start to see a little bit of upward pressure on things like the 10-year. Obviously, a more steep yield curve is going to be protective of net interest margins for financials. Pair that with an expectation for a little bit of financial deregulation to enter the picture in the next few months, and I would see a pretty constructive financial sector setup.